Banking. As a general rule, there are three types of bank accounts: an everyday account, a savings account, or alternatively a credit card. The main difference between these accounts is that with a credit card, you're actually using the bank's money to make any purchases. Whereas with an everyday account, or alternatively a savings account, you're actually using your own monies to make a purchase. This is an important difference that can have a huge impact on you financially over the long term. Your everyday account is generally seen as a working account, and it's usually characterised by high fees and a low interest rate. One of the ways in which an everyday account can be used effectively is to redirect the monies either into a savings account or alternatively pay your everyday living expenses. Many people use their everyday bank account to have their accounts or bills paid automatically via direct debit arrangement. This is important as it avoids a feast or famine situation where you may have a large lumpy bill payable in a very short period of time. And by avoiding the large lumpy bills, it also makes budgeting on the household a lot easier. When looking for an everyday account, it is important, firstly, to shop around for low fees, look around for a high interest rate, and also be careful not to use ATMs from other banks, as you'll pay a high fee in this instance. Savings accounts are used to help build your financial position, as saving is the bedrock of wealth. And is any money not spent today, but put aside for next week, month, year, or even for your eventual retirement? Savings can also be used for paying off a home or any other asset that increases in value. And it's important to remember that if you don't save, at the end of your working life you have nothing, no matter what your income is. Saving can be as simple as throwing change into a jar and banking it at the end of the month. If you save $2 per day, for example, from the age of 18, you would have saved $1 million at the age of 65, assuming a 10% rate of return. But we're not all 18 years of age, and it's never too late to start saving. If, for example, you save $5 per day from the age of 40, you'd have $200,000 when you reach the age of 65, assuming a 10% return. The dreaded credit card has caused the financial downfall of many. It has allowed consumers to buy products that as a general rule they can't afford. Let's take the example of an iPod, which costs $200. If you purchased this on your credit card and interest accumulated, you would owe over $322 in 5 years' time for something that is essentially worthless. This sounds unusual, but many consumers fall victim to this very problem. If you need more information, it's worth having a look at the website of any of the major banks. And remember, shop around, do your research, and it is important to look after number one. No one else will look after your interests better than you. Good luck.